On December 18th, 2024, the Federal Reserve cut interest rates for the third time in 4 months. Markets cheered. Bitcoin hit new highs. Everyone celebrated the return of easy money. But something far bigger happened that same week. Something almost no one noticed. A technical rule change. Buried in regulatory footnotes. No press conference. No headlines. And it just unlocked access to $29 trillion. Here's what you need to understand. For the past 2 years, we've been living in a world of tight money. The Fed raised rates, liquidity dried up, banks got cautious. The whole system was supposed to be running on fumes, except it wasn't. Because while the Fed was tightening from the front door, they left a side entrance wide open. A facility designed after the 2008 crisis, a backup system for banks. A place where financial institutions could quietly access cash without anyone asking uncomfortable questions. It's called the Standing Repo Facility, and until recently, it had limits, rules, restrictions on how much could flow through it. Those restrictions just got removed. Not loosened, removed. The pipeline is now fully open, and the amount of collateral that can be funneled through it, $29 trillion, that's the total value of U.S. Treasury securities and agency debt currently sitting on balance sheets across the financial system. So while everyone was watching the Fed's quarter-point rate cut, they missed the part where the plumbing of the entire monetary system got rewired. Let's rewind and explain how we got here. After the financial crisis, the Fed realized they had a problem. Banks would occasionally run into short-term cash crunches, not because they were broke, but because of timing mismatches. They'd have plenty of assets, but not enough liquid cash on hand for daily operations. In 2021, the Fed created the Standing Repo Facility as a solution. Here's how it works. A bank shows up with Treasury bonds, high-quality collateral. They hand it to the Fed temporarily and receive cash in return. The next day, or a few days later, they reverse the transaction. The bank gets its bonds back. The Fed gets its cash back. Everyone's happy. It's technically a loan, but it doesn't look like one. It doesn't get reported like one. It's classified as a repurchase agreement. Repo for short. The original design had a catch. Each bank could only access $5 billion per day. Sounds like a lot until you realize major institutions move hundreds of billions daily. The facility was a safety valve, not a fire hose. But in late 2024, that changed. The Fed announced a new structure. No more individual limits. Instead, banks could now bring in any amount of eligible collateral. Treasuries, agency securities, mortgage-backed securities guaranteed by the government. All of it suddenly became liquid. The stated reason? Operational flexibility, making sure the system runs smoothly. The unstated effect? A backdoor to unlimited liquidity. Because here's the thing, the total stock of Treasury securities and agency debt held by the financial system is roughly $29 trillion. And now, theoretically, all of it can be converted into cash overnight. Not loaned against, converted. Now, before you panic, no, this doesn't mean $29 trillion of new money is about to flood the economy tomorrow morning. But it does mean something. It means the Fed has created a mechanism where the constraints on money creation are no longer binding, where the difference between tight policy and loose policy becomes a technical footnote rather than a structural reality. Think about it this way. When the Fed raises interest rates, the idea is to make money more expensive, to slow down lending, to cool off the economy. That's the theory. But if banks can always access cash by simply parking their treasuries at the Fed's repo facility, then rates don't matter as much. They still have liquidity, they can still operate. The brake pedal got disconnected from the wheels. This is why, over the past year, financial conditions never really tightened the way they were supposed to. Stock markets kept climbing, credit kept flowing, risk assets kept rallying. Everyone kept wondering, where's the recession? Where's the pain? The answer was hiding in the plumbing. And now that plumbing just got a major upgrade. Here's where it gets strange. The Fed will tell you this is just a technical adjustment, that it's about efficiency, operational resilience, making sure markets function smoothly. And maybe that's true. But there's another way to read this. The Fed spent 2 years talking about fighting inflation, about restoring price stability, about making tough choices. And then quietly, they opened a facility that allows the financial system to bypass the entire tightening cycle. It's not quite money printing. It's more subtle than that. It's liquidity on demand. Cash without the stigma, a way for the system to keep running even when policy says it should be slowing down. Some analysts are calling this the new implicit easing. Others are saying it's just the Fed learning from past mistakes, making sure they don't trigger another 2019-style repo crisis. Both could be true, but the irony is hard to miss. We're living in an era where the central bank says money is tight while simultaneously building infrastructure to make sure it never actually gets tight. So what does this actually mean for markets, for the economy, for you? Honestly, it's hard to say. On one hand, unlimited access to liquidity is stabilizing. It prevents sudden shocks. It keeps the gears turning. No one wants a repeat of 2008, where solvent institutions collapsed because they couldn't access short-term funding. On the other hand, it creates moral hazard. If banks know they can always get cash from the Fed, they take more risks, they lever up, they stretch for yield, because the downside is capped. The safety net is always there. And here's the uncomfortable part. This facility doesn't exist in isolation. It's part of a broader pattern. Central banks around the world have spent the last 15 years building backdoor liquidity mechanisms, swap lines, repo facilities, emergency lending programs, all of them designed to make sure the system never runs out of cash, which sounds great until you realize what it actually means. It means we've created a financial system that can't tolerate even temporary stress, a system so fragile that it requires constant life support. And the more we build these safety nets, the more we encourage the kind of behavior that makes them necessary in the first place. There's a bigger question here. If the Fed can always provide liquidity, and if that liquidity can always flow through technical facilities that don't show up in traditional monetary aggregates, then what does tight money even mean anymore? We're told the Fed is data dependent, that they watch inflation, employment, growth, that they adjust policy accordingly. But if the policy transmission mechanism has been rewired, if liquidity can always find a way through, then maybe the old models don't work anymore. Maybe we're in a new regime, one where the appearance of tightening matters more than the reality, where the Fed talks tough but builds escape hatches. And maybe that's fine. Maybe that's the price of stability in a hyper-financialized economy. But it does raise a question. If the system requires permanent liquidity support to function, is it really stable? Or are we just getting better at hiding the cracks? $29 trillion. That's the number. Not money that's been created, but money that can be created anytime, anywhere, just by walking through the right door. The Fed didn't announce this with fanfare. They didn't frame it as a major policy shift. They just opened the valve. And now we wait to see how much pressure builds behind it. Because the thing about liquidity is, it always finds a way out. The only question is where.